to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Square Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Morten Nilsson, CEO of Brightwell, to this episode. Morten, hello.
Great to be on the show. Thank you, Charlotte.
Lovely to have you here. We have a Dane, and I'm a demi-Dane, so I'm very excited about this. I've just been laughing about the Danish language and its lack of romance. Do tell us, Morten, what is your news story of the week?
So my news story of the week is that UK, to make it easier for companies to access pension surpluses, published in the FT on the 29th of May.
And what is it about this news story that stuck out to you? Why have you chosen it as your news story of the week?
Well, I think this is quite groundbreaking, and I think it means that companies might end up seeing their pension schemes as an asset rather than liability. So I think it could change quite a lot. Of course, this is early days, and a lot of detail is missing, and I'm hopeful government will do a good job on that detail, but that's yet to be seen. But what they have said, which is and this is something that has been talked about for quite a long time. Even the previous government started to think about surplus release. But what government published last week was that it would look to have a sort of a statutory override, which is needed for trustees to be able to override the scheme rules to allow for surpluses to be used, and that they would base that on a low dependency basis versus a buyout basis. And I think the difference in financial terms between the two surplus definitions is 5 to 10% of overall funds, so quite significant. So I think that is really interesting, and I do think, as I said, that this means that sponsors will potentially have access to surplus, which means they'll think differently about the pension scheme, and not just focus on having liabilities they need to get rid of, but actually start to think differently about it. I think it allows trustees to think differently about it as well. And it kind of has been, to me, quite an odd situation where the sponsors owned all of the downside risk with the pension scheme and all the liabilities, but had no access to surplus. And actually, some of these surpluses could only be accessed at the very end of when the scheme was wound up, which seems very inefficient that you lock up more money than you need for 60, 70, 80 years or however long. And of course, in most cases, pension trustees were not allowed to use those surpluses either. So I just think it's really quite important. And I think it will also have an impact on investment strategies and risk-taking and other things.
Well, I mean, as you say, to change the pension scheme from a liability to an asset is an enormous change. And it does basically change the thinking about pension schemes over the last 2 decades. Because ever since we brought in new valuation methods, they've really been basically the enfant terrible in the balance sheet for the finance director. Until everybody got everything locked down with a DI, you never quite knew every valuation what it was going to be, whether it was going to be up or down. So that really is a fundamental change. And obviously, I think that has an ability to change or shift the rhetoric and the conversation we're having about buyout versus run-on. Do you agree? And how do you think that will shape those ongoing discussions?
I totally agree with that. And I think the gold standard used to be buyout, and more or less every scheme in the country was aiming for buying out the scheme as soon as they could. And I think many finance directors had the same aim: get rid of the liabilities to an insurance company as soon as you can afford to do that. But of course, now I think there's a real reason to consider run-on as a real opportunity, and consider that for a longer period of time. I think at the end of the day, most schemes will end up buying out the last few members, but I think they will they will have the opportunity to think longer term. And I think that what I would really encourage in that is that you think about it as a choice that you run on. It's not just because I think some schemes have been thinking we're doing it until we can buy it out. But I think it's worth thinking about it as a proper choice, because there's a lot of complexity in here. It needs to be deliberate, and if it is deliberate, you can make longer term decisions. We've developed a toolkit which is available on our website if anyone's interested. But I really think it is a deliberate choice. And to the point you were making before, we've gone from suddenly having mark-to-market assessment of our assets and liabilities, and suddenly swinging in and out of surplus, and becoming very focused on the here and now, instead of really leveraging our advantage of being long-term investors. So I think it has a lot. It will have a lot of implication.
Yeah, I think that's true. So let's talk a bit more about the surpluses. I mean, who doesn't love to be in a surplus? We've talked about this a bit with Emma Cameron a couple of podcast episodes ago. But tell us more about what you can do with a pension surplus.
I mean, I think perhaps if I may say one thing before I go into it, I think it's quite interesting that I think there are three different types of schemes. There are schemes that are in deficit. There are schemes that are fully funded on a technical provisions basis, or even a low dependency basis, and there are schemes that are fully funded on a buyout basis. And I think trustees will think differently considering where they are on that journey, and it gives different opportunities and risks for everyone. But I think it's quite interesting. We surveyed finance directors recently with schemes over 500 million, and what they said was that 93% of UK businesses that we surveyed said they would expect to access their pension surplus. Nearly half, 49%, plan to use these funds to invest in their UK operations, which again is supporting the UK government's objective to boost the UK economy. 43% said they would want to access scheme surplus in the near term. And 44% intend to share surplus with members, which is quite a high proportion. And again, I think that depends on what kind of indexation rules you have in the scheme, and all sorts of other things. 42% plan to reinvest in global operations, 40% want to distribute to shareholders, and 33% would use them to cover costs and expenses associated with their DC arrangements, and 22% said they would use it to fund the contributions for the DC scheme, which is again a pretty reasonable way of using surplus. So I think there's a lot of balancing stakeholder needs in that, whether it's in current employees versus previous employees, whether it's members versus shareholders, or investing in the operations, but quite a lot of different use for that surplus.
I mean, I can understand. I mean, if I were a finance director and I had done the roller coaster ride of the enfant terrible and balance sheet, I might want to claw back some of that surplus, as I've already put in probably hundreds of millions.
Yeah.
But I see from the trustees' perspective that they would want to return it to members. And as you say, current versus previous members, that's also an interesting debate. Yeah. Have you any sense about how that discussion is evolving? I mean, beyond those statistics, are you seeing people sort of change their mind or become more interested in the surplus because they think about, I could invest it for 20 years and I could make extra investment returns on it? And how's that that competition between those three sort of demands for money?
I think that, and of course, they also one doesn't necessarily say the other can't have anything. It could be a split in different ways. But I think what I also am seeing is that there's a lot of thought about how do you actually value the sponsor in as an asset of the scheme, effectively, that covenant. And I think there will be for many schemes quite a big interest in actually using these new rules and the ability to sponsors to access surplus, to look for other ways to get more security from the sponsor should the pension scheme ever need any. So I think we're just at the beginning of a very interesting debate that will go on. And as always, where you have these big shifts in that this is where we've gone from the last couple of decades really been worrying about how do we secure member benefits to now worrying about how we distribute a surplus, which must be a much more positive problem to have. I think we're all catching up, and I think the advisory community is catching up. The providers, as Brightwell, are thinking about this quite carefully. I think trustees are thinking about it, and I think we will see a lot of innovation come out of this because this is a real new. It's a real new world we're entering, and we need to make sure it's thought carefully. How do we safeguard member interest in whatever is happening, and how do we leverage all the benefits that might be possible from this?
You've mentioned this a few times, and it's mentioned in the article too. You talk about a low dependency ratio. I like to think after 20 years of writing about pensions, I know most of the technical geekery, but I don't really know what low dependency ratio is. And I'm hoping that I'm not sort of mollycoddling my listeners, but maybe there are some other listeners listening to this thinking, what is a low dependency ratio? So could you explain that for us, please?
Yeah, so low dependency is a term that was designed by the TPR to ensure members receive their full benefits with a high degree of probability. And the low dependency is a low dependency on the sponsor to support the scheme. And as I mentioned earlier, the difference between that and buyout is probably about 5 to 10% or something like that. So quite significant. But it is a very safe funding level. I think it's quite interesting when we get the details from the regulations, because what I feel very strongly about is you can only pay a surplus when you are in a surplus where the funding volatility is managed very carefully. You can't be in surplus one day and out of surplus the next. And of course, what we have seen is many schemes were in deficit, and suddenly we had an interest rate change and they were in surplus. And we can't have those kind of swings. That just isn't good enough. So I think there will be a lot of focus on how do you align the investment strategy to the risks of the scheme, and how can you comfortably say that you are at a low dependency basis. And my hope, which is again not known exactly how that's going to be set out, my hope is that it will be set out on principles. So for example, in an insurance world, if you don't hedge your longevity risk, you need to hold more reserve capital because it's a risk you have outstanding. And if you hedge your longevity risk, you can have lower reserves. So I think thinking about it in those terms will be what I hope we'll get out of it, that you can actually look into, open up the strategy. And if it is a well-managed overall strategy, then you need less reserves than if it's a higher risk strategy.
I'm a big fan of the Purple Book. Now, I'm a big fan of the Purple Book because I think in the whole industry, their infographics are just incredible. They're very, very good at representing really complex things about pensions. And my standout chart from the Purple Book is in 2023, the graphic from how many pensions in deficit to how many pensions in surplus. It's just gobsmacking. It goes from this tiny little purple circle to this enormous, great big pink one. So yeah, I mean, that was a big change. And obviously pension schemes, when they're thinking about surpluses, it's a very different time to 25 years ago when we introduced all these new accounting rules. And there is a sort of established way of managing a DB pension scheme where you're going to lock in your current funding rate using hedging and the like. So this is a much more permanent and safe option than, say, if we were back in the 1990s when people used to take pension contribution holidays. But if you have this surplus, given that you still have to lock in those LDI levels, what are the implications from investment? We are the professional investment podcast after all. So how is it going to change how you invest? What is it going to open up? What's going to be a possibility and what isn't? If we can talk about the things that pension schemes are doing, and even the potential asset classes that they might now be looking at that they wouldn't have looked at in the past.
I mean, I think what it means is we will be investing very similarly to insurers, but we don't have the same investment restrictions, which means that we have a broader investment universe, which I think we will leverage. So we should leverage the areas that insurers don't have access to. But I think in trying to answer your question, I think that what I think makes a lot of sense for pension schemes, mature pension schemes and run on, is that most will have negative cash flows. So it becomes really critical to figure out how do you try to match your outgoing cash flows with your incoming cash flows. Mm-hmm. And in that, you will think about, do I need to fix my outgoing cash flows via longevity swaps, etc.? Do I believe in that or not? But understanding your outgoing cash flows becomes really important, which is actually also a member data thing. Do you have proper member data so you can assess your liabilities in a careful way? And if you don't, everything else is more tricky. Then I would say that you would build up this cash flow matching portfolio, which would be a lot of credit, secure income, those types of assets, where you can look at your incoming cash flows and where you have natural liquidity in your portfolio coming from those investments. And then you need to think about in inflation, especially, and a bit of rates exposure and reinvestment risk. But I think it becomes, and I think it's interesting actually. Sorry if I may go back to your low dependency basis. I don't think the regulator is fully ready to consider these cash flow matching portfolios because they work very differently than traditional equity bond portfolios. Because here, what really matters there is if you have a big credit portfolio and you want to keep your bonds till maturity, you don't really care about the market price. You care about the default rate, and that becomes a much different. And that actually gives you a lot of stability. That you can kind of look through the immediate market swings, as long as the default rates are you have enough prudence in your default rates, and hopefully have managers who are picking good bonds. But that becomes quite a fundamental shift.
I mean, there is a challenge, isn't there? Because basically, the world and his wife wants global credit. The pension schemes want global credit for all of the reasons you've just outlined. Yeah. The insurance companies want global credit because their regulatory environment kind of forces them into a lot of global credit. And we've seen global credit all in yields have increased, but that's been basically driven by the government bond yield, and the spreads have tightened. So people have been, and that's going to be an ongoing problem, I think. People are going to need to find other fixed income assets that are going to deliver those levels of income, but maybe at a better price. I know there's been huge interest in ABS. Are there other asset classes you think will be of interest? And are we talking, I mean, obviously we can't start investing in the really risky stuff, and we don't want to invest in, because schemes might decide they want to go to buyout, so they may not invest in private assets which have too long a maturity timeline that take 5 to 7 years, that kind of thing. So where do we go if the world and his wife is chasing global credit?
I mean, I think that, I would say I would really encourage the manager selection for this has to be very careful, because of course, if the manager is just driven by AUM growth and not doing their proper due diligence, then it becomes a risky venture when so many people are going into credit. But I think there are private credit opportunities. There's direct lending. There's all sorts of ways to spice up your returns from this and smooth out your returns. I think you're right that for many pension schemes, many mature pension schemes, it becomes harder to be a long-term investor into private equity and infrastructure and those types of investments. But I think there will still be quite a lot of secure income routes that can be pursued. And then I think, as always with pension schemes, size matters. If you have scale, you have access to other things. Which has been one of our themes, really consolidating mandates, so we find really strong managers who can deliver different parts of what we need, and have sizable mandates with them. So we have more influence and more better fees and all those things. All helps. But I'd also say that one other shift in being a mature pension scheme paying out significant pensions is that precision becomes quite critical. You can't not know what your liabilities are, because then you might be overhedged or underhedged, and you can't be. It just doesn't work. If you have significant outflows, you need to have quite a long-term view on where those cash flows are coming from. And if you have it long enough, you can ride out most cycles. So I think again, cash flow management, it sounds so simple. It just isn't quite as simple, but it becomes a really key aspects of what you're doing.
I think cash flow management, even for one person, is a difficult thing to do, let alone when you're trying to predict 40 years into the future about how long somebody's going to live and all of the rest of it, and have the right data to know that, I don't know, this many percentage of your proportion of your pension scheme lives in a particular postcode where people are likely to live to 100. All of that kind of complexity, I'm glad I don't have to sort it out, put it that way.
Yeah, but also I think perhaps being more agile in how you're adapting to this, how you're thinking about the required returns you need to deliver, how you're thinking about and measuring your liabilities and considering mortality trends, etc. I think we've done that too infrequently because we haven't had the systems and the capabilities. But computing power is different now. I mean, we can do this much more granularly. AI is helping. There are all sorts of tools that can help us be more precise and more timely with what we're doing.
I have to say, I think that's the first time I've heard the word pensions and agile used in the same sentence.
I know.
So we chose this new story, or you chose this new story, but last week, actually, even though it was like half term, just before half term, it was half term, wasn't it? It was a really busy news story week. We also saw the final report of the pension investment published by the government. And I just wondered if you could give us some context, how you think this surplus announcement sits within the government's policy about the economy and pensions, and what we can gather from those two sort of big announcements and ongoing sort of conversations the government's having about where it wants pensions to go and what role it's going to play in the economy.
I mean, it's very clear that this is also part of the overarching growth agenda from government and the mission to try to find financing for quite a lot of projects where the UK need more investments in infrastructure, more investment in the energy transition, more investment in defense, more investing in all sorts of things. And I think therefore it's very much part of that agenda. And I think the surplus release, if they have ways of putting some of that surplus back into society and back into growing the UK economy, that must be positive. But I also think that I think it's totally reasonable to have a debate with local pension schemes about how can we use all the trillions of pounds that we are sitting on to the benefit of the society we all rely on and the economy, the UK economy we all rely on. I think that's totally sensible. I've never been a big fan of mandation because I think you end up having the wrong people forcing decisions. But I think we would really encourage that dialogue with government, and we would be more than willing to participate in it, because pension funds for us, the UK, pounds is our neutral currency. We are here to stay. We don't need excessive returns, but we do need more secure returns than some other investors. And I think if we are used if government engages in the right way, there will be a lot of money that could be invested in the UK economy to the benefit of everyone. But I think there's a bit on the government side also of making it attractive, making sure you're not putting so much emphasis on attracting foreign investors that you give them all the good deals, and then you say to your local pension schemes, you just take whatever's left. So I think there's a bit in working in a collaborative way on finding solutions to this.
Yeah, and that also fits with the Labour's agenda to really take a look at planning laws, because whenever I've written about infrastructure in the past, everybody said, I'd love to invest in infrastructure. It's a great fit. It's a great fit for my liability matching. The problem is there is no infrastructure because every project takes so long. Yeah. So I mean, in that way, there is a coherent strategy. You can't really say that much about the current government, but in that respect, there is a coherent strategy, and that you can't encourage people to invest more in infrastructure unless you create an environment where we can actually create more infrastructure.
I totally agree. And also, of course, when you are investing in infrastructure, you will need people across the whole capital structure. And the more mature pension schemes might not be on the equity side, but they might be on the credit side of it. So I totally agree. But I also think part of all of this discussion is perhaps some pension schemes have underestimated the political risk of some of these infrastructure assets, and some governments have underestimated that. Of course, part of the idea with infrastructure is that it's inflation linked. And if you can't pass on those costs to the consumers because there's a cost of living crisis, that just undermines quite a lot of the investment thesis for those investments. And I also think that perhaps the other thing that isn't fully taken into account is the liquidity premium that also is within these investments. And the more secure that investment is, and the more government does to make sure that future regulatory structure is well understood and reliable, the better you can manage that risk as well.
You said something, you touched on it, was something I wanted to talk about as well. There's horses for courses, isn't there? So you have to be realistic about which type of asset class is going to appeal to which pot of institutional money. We're not going to see closed schemes, even if they've got healthy surpluses, start to invest in lots of private equity, like you mentioned, or maybe some of the riskier ends of fixed income. Possibly they would. And so there is a sense, isn't there, that you've got to understand which pot of capital. You're not going to invest in venture capital. That could be a viable option for DC or even the LGPS. So yeah. I think there's a greater understanding in the government now that that we do have three very distinct pots of, well, four actually, if you include insurers, of institutional money, and each has its own quirks that are basically shaped by regulation and the nature of that of the beast, so to speak. So
I think that's a very good point.
Yeah, so there has to be that understanding that you have to target the right thing at the right pot of money as well.
Exactly, and of course, but the other side of that is, as you have all these different asset owners, you actually also can plug all the gaps in the capital structure. And I think even mature pension schemes have some risk capacity left, but they might just prefer to use it in different ways. And we can't put everything on red. We need to spread out our risks a bit better than that. And but of course, we can take some risks, and it might be, as you say, where we have some high yielding credit opportunities, or it might be other stuff. But I can't just say enough that we can fill the whole capital structure with pension schemes and local asset owners. There's a lot we can do.
I think that's a great point for us to end our discussion. Thank you so much, Morten, for sharing your news story of the week and for all of your insight and laughing at my jokes. Listeners, I hope you enjoyed this episode. Please make sure you never miss a future episode by hitting the subscribe button and do interact, engage, and comment. Thank you for listening.